It's oftentimes companies like this that get people really excited to invest in a company. They see revenue charts like this that are just going almost vertical. They're exploding in their numbers. And oftentimes it leads to their share prices doing a similar thing. You see in a 5-year period where a stock goes up 600% and you instantly want to rush into the company and you get excited by the massive gains that you're missing out on. The problem herein lies in the short term though. When you enter into a recession and you finally start to face some headwinds, issues begin to arise. And that's what I want to talk about in this video. This isn't just so much about Nvidia. Nvidia is the example, but I want to talk about these style of companies, these high growth, high profitability companies that finally start to face some headwinds and then immediately crash in share price. Down over 40% year to date, this company from its all-time high to where we're trading at today is now cut in half in share price. And I want to talk about what to look for, what you can avoid, and what you should do moving forward to prevent yourself from facing massive losses when these type of high growth, high profitability, exciting companies eventually get cut in half in share price. Thank you for tuning in. My name is Jordan. If you haven't seen me before, I'm a millennial investor, and I showcase my portfolio through these charts that I share in the description down below, with my portfolio balance being shared in every single video and updated every single month, as well as my growth holdings, which right now is Salesforce, Amazon, Google, and Crocs. Now, I also show my portfolio balance as of every video, which is right now just under 39,000, and this is my portfolio so far for the year. Now, I also share these portfolios down below in the description using M1 Finance, this fantastic broker, so check it out if you haven't already. You'd help support me in the channel, and 126 people have done so far, and you would help support me in the channel. So thank you guys for tuning in, and without further ado, let's go ahead and jump into Nvidia stock. Now, this is a company that has had massive revenue growth. Its 1-year growth rate from 2021 to 2022, the fiscal year, was 61% revenue growth. The 2-year was 57%. And over a 10-year compounded rate, this company has grown its business 21% year over year over year over year. Now, the profitability has done a similar story. In fact, it's actually grown faster at a compounded free cash flow growth rate at 26%. Now, free cash flow per share is about the same, with this company not being very dilutive, also growing at about 26%. And this company is at the heart of what every millennial and every Gen Z investor wants to be a part of. What people get excited to invest in is high growth, high name category companies such as this one that are in all the sexy, appealing industries. Look at these names, whether it's gaming, whether it's AI, whether it's Omniverse, chips and motor systems, or automotive. You see the types of categories that this company is in. It is in the massive $1 trillion opportunity, as it says here, that gets investors excited. And you see these types of slides that showcase its growth. Look at this opportunity for its gaming. You see that people are more inclined to spend more time on video games than they were before. Gen Z spends 1,000,000 times more on video games than boomers do. And the same thing can be said about things like its data centers. And you could also say the same thing about its automotive, which is projected to grow massively over the next decade. Look at these projections that they're making out in 2030, 2035, and alike. And even investors are projecting that this company is going to grow year in and year out, and next year's projected to be 16% growth, and next year after that is projected to be 18% growth. But that leads me to where we're at today. If I go over to the research tab here with M1 Finance and I type in ticker symbol NVDA or Nvidia stock, you can see that, like I said, year to date, this company is down almost 60%. And that even factors in today's big green day of 3%. So just yesterday, this company was down over 60% for the year. Now, why is this company having such a hard time? Now, to be fair, the stock market has been down, so pretty much all companies has been having a hard time, with the S&P down 25. But why is a company like Nvidia literally down 2/3 in share price in just 9 months? Well, this leads me to the issue with Nvidia stock. I talked about this video, and the title of this video is the issue with a company like Nvidia, and it leads me to the quarterly numbers right here. You see its quarterly revenue growth. It's gotten better and better and better and better until the most recent report. Now, this revenue did finally go down quite dramatically, going back to where basically year over year this company had very little growth, just a couple percentage points. And it's interesting to see where this company will play out next quarter, because I think we're at risk of having some negative free cash flow and negative revenue growth. Now, the revenue looks great. It looks great over time, but the last quarter has not been very good, only growing 3% in the last year. But that's not the real issue. The real issue leads us to the net income, the profitability of the company. Because if you look on a 10-year basis, this company's been growing its net income at 18% year in and year out, almost 20% a year, which is massive opportunity for shareholders, as you obviously want to be focusing more on profits than you do revenue. And speaking of focusing on more on profits than revenue, like I said, you saw this revenue go up still slightly, 3%. Not bad, but not very good either for a big growth name like this. 3% is not what you're investing in, but the profitability on a year-over-year basis is down 72%. And notice how that's similar to what this share price is down from the peak at around 60%. And so it's high growth names like these that cannot maintain margins when times get tough. Now, this video is not to rag on Nvidia stock. There's lots of other companies that have had their margins compressed and have had a tough time going into this recession. But let's give an example. If you didn't know, I just made a video, just the very last video I made, just 24 hours ago, so check it out if you didn't check it out. But I made a video about Google and why I decided to invest about $10,000 into Google stock. And if you look at this company, this is a company that has also faced issues with its margins and its profitability has come down. But let's compare this to an Nvidia. Its big downturn in profitability is down 13%. That's not good, but comparing that to Nvidia's 72% downturn, that's not that bad. And this is obviously in times of recession when times get tough. You want to see companies that only have their profitability and their margins go down a little bit rather than tank through the absolute floor like an Nvidia has. Let's look at the margins. Let's look at the little margin ratios that we have here on Qualtrim Insights, and let's look at the operating margin. You can see that going to the end of 2021, this company was running at about 30 to 32% operating margins. What is it running at today? Well, the most recent quarters were around 30 and 28%. So it's went down a little bit. It was going from the mid to low 30s to now it's in the high 20s to even 30%. It's really only went down about 1 to 2%. And the same thing can be said for the profit margin on a year-over-year basis, only being down a little bit. Let's compare this to Nvidia and its operating margins and see how this company is down on a year-over-year basis. At the end of 2021, its operating margin currently sat at right about 38 to 39%, right here, what I'm highlighting. Now, what is it at today? The most recent quarter came in at 7. Just hear that out for a second. Its operating margin, meaning the profits it actually earns from its actual operation of selling chips and data centers and gaming products and all that types of good stuff, was originally running at around 38 to 39%. Today, it sits at 7. So that is a dramatic downturn. And you can see this as well in the free cash flow. One of the big benefits to owning a company like this is that if you look at their shares outstanding, they're finally starting to buy back shares. See how they've been diluting you for years and years? And then finally, over the last quarter or two, it started to trickle down because they're starting to use their cash flows to buy back their own shares, which of course is accretive to you as a shareholder. And the reason they've been able to do that is because this company's produced billions of dollars in free cash flow a quarter. At the beginning of the year, they produced $2.7 billion in free cash flow, and then what did they do this most recent quarter? $800 million. And so when it's numbers like these that take these companies down, I think it's what you should get concerned about. Now, here's the thing you might be saying to yourself, Jordan, I still want to invest in companies that grow 20% growth rates year over year. I don't want to invest in a company that doesn't have high growth. I want to invest in companies that grow a ton. Well, like I said, I just invested in Google. What is its 10-year growth rate? On a 10-year basis, it's up 19% compounded, almost the exact same as Nvidia. Or what about my largest investment? If you see here on the pie, my number one investment in the portfolio is CRM, Salesforce. Salesforce, if you look at its 10-year growth rate, it's currently growing at 26%. It's exceeding that of Nvidia. And more importantly, the coolest part of all this is that if you look at its free cash flow, not only is it keeping its margins, it's actually increasing them in a time of a recession. It is extremely rare to see a company continue to grow year in, year out, quarter over quarter, and not only grow, but increase its margins when we go into a recession. When you look at these numbers that I put up for Salesforce, it's just absolutely ridiculous. Even in the most recent quarters, growing 22 and 24% enter a recession, and we're projected to have the highest free cash flow we've ever seen. And so that's the problem with many high growth, speculative, retail heavy names like Nvidia, is that if you're expecting big returns moving forward in times of recession, that's often not the case. It's very common to see investors pile in when this company's at $300, $350 a share, and then get burned and be forced to sell out when it trades at today's price of $125. So don't be one of those people who invest in this company when it's at peak prices. This is a great company, it has lots of room for opportunity, and I think that this $1 trillion opportunity will come to fruition. I think we will see a day where this company's market cap is $1 trillion plus. It's inevitable. This company's growing ridiculous, and while I don't think they'll hit these type of growth rates moving in the next year or two, I do think this company will continue to grow at 10, 15, 20% over the next decade to 2 decades. Now that said, it is not one that I want to be buying now. It's free cash flow yield. Compared to many other high growth names out there, it's just not attractive enough for me. It's not a company I hate. If you want to invest in it, that's fine. Do your own research, do your own due diligence, but it's not one that I want to be investing in, and it's the problem that I see with high growth name investors such as this. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already, and help support me in the channel and get $10 for signing up with M1 Finance. Thank you guys so much for watching, and I'll catch you guys next time.